All right, let's talk high-income portfolios. If you're building one, you've probably loaded up on all the usual suspects, right? Covered call ETFs, high-yield dividend stocks. But what if there's a huge piece of the puzzle missing? Today, we're diving into some fantastic research from the Blueprint to Escape team on an asset class that could be the perfect diversifier you've been looking for. Okay, first things first, we gotta do the mandatory disclaimer. Just remember, everything we're about to discuss is for educational and informational purposes only. It's definitely not financial advice, so please make sure you chat with a qualified pro before making any moves, right? Let's get into it. So let me ask you something. Take a good, hard look at your income portfolio. Is it packed to the gills with covered call ETFs on, say, the S&P 500 or the NASDAQ? Now, those are fantastic tools, don't get me wrong, but it probably means your income is tied almost exclusively to how a handful of public companies are doing, especially big tech. And that, my friends, is a hidden risk, overconcentration. So what's the fix? How do you get your income stream away from being so dependent on the public markets? Well, there's this powerful and honestly often overlooked solution: business development companies, or as we'll call them, BDCs. You can think of these as your own personal gateway into the massive world of private credit. So what on earth is a BDC? Well, put simply, it's a company you can buy and sell on the stock market, just like anything else. But here's the cool part. Instead of making a product, its entire business is investing in small and medium-sized private companies. You see, ever since the big financial crisis in 2008, traditional banks have really pulled back from this kind of lending. That created a huge gap, and BDCs stepped right in. Essentially, they let you, the average investor, act like a bank for Main Street. And the business model? It's beautifully simple. Step 1. The BDC raises a bunch of money by selling shares to people like you and me. Step 2. It takes all that cash and lends it out to growing private businesses, charging them interest. And Step 3, this is the most important part for us, it's required by law to distribute almost all of that interest income back to us, the shareholders, usually in the form of hefty dividends. And this right here is the absolute key for your portfolio. Your covered call ETFs? They get their yield from selling options on public stocks. BDCs, on the other hand, get their yield from interest payments on loans to private companies. It's a completely different economic engine. This gives you real, true diversification away from the same tech giants that drive so many of the popular income ETFs. Of course, it can't all be sunshine and roses, right? No investment is perfect. So let's get the complete picture here. We're going to look at the big benefits, some potential risks you need to know about, and tackle a very, very common question about fees. The benefits are pretty clear. That high yield potential is obviously the main draw. But just as important is that diversification away from the public markets. You get access to the private credit world, a space that used to be only for the super wealthy. It's an amazing hedge against that sector concentration we were just talking about. But, and this is crucial, you have to understand the risks. BDCs lend to smaller companies, so there's always a credit risk. The chance a business can't pay its loan back, especially if the economy turns south. They can also be sensitive to interest rate moves. Knowing both sides is absolutely key. Now, let's talk about the elephant in the room. If you've ever looked up a BDC ETF, you might have seen an expense ratio that made your jaw hit the floor. You're thinking, wait a second, are the fees really over 10%? It's a totally fair question and probably the single biggest misconception out there. Let's clear it up right now. The reality behind that sticker shock is just a weird accounting rule. It's called Acquired Fund Fees and Expenses, or AFFEs. Basically, the ETF has to report the internal operating costs of the BDCs it holds within its own expense ratio. But listen closely. These are not an extra fee you pay. They're just the normal costs of doing business for the BDCs themselves, costs that are already baked into their stock price. To put it simply, you are not being double charged. Okay, with that fee confusion out of the way, let's get to the fun part. How can you actually invest in this space? Well, for anyone who prefers a more diversified, hands-off approach, let's look at 2 actively managed ETFs that do all the work for you. For our friends in the United States, a really popular choice is the Putnam BDC Income ETF. The ticker is PBDC. It's actively managed, which means you have a team of pros picking and choosing a whole basket of BDCs for you, trying to get you broad, solid exposure to the entire sector. And for our Canadian viewers, don't worry, we've got you covered. There's the Accelerate Diversified Credit Income Fund, ticker INCM. This gives you a similar one-stop shop solution. It's actively managed and designed specifically for Canadian investors who want to tap into the private credit market. But hey, Maybe you're the type of investor who likes to get your hands dirty, do your own research, and pick your own stocks. Well, for the more adventurous out there, the research team highlighted 4 individual BDCs that are definitely worth a closer look. First up, we've got Hercules Capital, ticker HTGC. These guys are an absolute powerhouse in what's called venture debt. They lend money to those really innovative high-growth tech and life sciences companies, a super exciting and potentially very rewarding part of the market. Next is Trinity Capital, or TRIN. They also play in that growth stage company space, but they have a really cool niche in financing essential equipment for these businesses. So it adds another interesting layer to their whole model. Then you have Blackstone Secure Lending, ticker BXSL. As you can probably guess from the name, they're backed by the private equity giant Blackstone. Their whole game is focusing on first lien senior secured loans. All that means is that if something goes wrong, they are first in line to get paid back, which makes it a more conservative play in the private debt world. And finally, we have a real fan favorite, Main Street Capital, ticker MAIN. These guys are famous for their super long track record and their unique approach. Not only do they provide loans, but they often take small equity stakes in the companies they invest in. That gives you, the shareholder, potential upside that goes way beyond just the interest payments. Okay, so we've got ETFs for a broad approach and individual names for the stock pickers. The next logical question is, how much of your portfolio should you actually put into this stuff? Let's talk about putting this research into practice. So based on the model portfolio from the team at Blueprint to Escape, they suggest a target allocation of somewhere between 20 to 30% for BDCs. Now that's just a guideline, but it's enough to provide a really meaningful diversification benefit without going all in on a single asset class. And here's why that matters. When you see the results, it all clicks into place. Their model portfolio, which uses this exact allocation strategy, is targeting an incredible overall yield of around 12%. And BDCs are a core reason they can hit that number. It's that powerful blend of high income and true diversification. Now, if you want to see exactly how they build this kind of portfolio from the ground up and how BDCs fit in with all the other asset classes, the team actually invites you to subscribe to their work. You'll get to see their full 2026 model portfolio. It's a fantastic way to see the complete picture. So we'll leave you with this final thought to chew on. Your portfolio is already earning income from the public markets, right? But after seeing the potential here for high yields and real diversification, maybe it's time to start earning income from the private markets too. Something to think about. Thanks so much for tuning in.